Hi everybody, this is Alan Ellman, the Blue Collar Investor, with today's covered call writing question of the day. Today's question comes from William. Alan, you covered, pardon the pun, what happens when a stock gaps down. How about what to do when a stock gaps up like 20% that happened to HOG, Harley Davidson, Friday, takeover rumors? And it's signed William. Well, William, there's always something to do to enhance our gains or to mitigate losses, and we must be on guard to act in a timely manner when these opportunities arise. This is a major opportunity for us to generate a second income stream in the same month with the same cash, a strategy that I call the mid-contract unwind exit strategy. Let's first have a look at the news release that William is alluding to. And on the screenshot, you see Harley Davidson stock rockets on heavy volume amid reports of buyout interest. It goes on to say that the price of the stock soared by 18% on heavy volume, putting it on track for the biggest one-day gain in over 7 years. This is a big deal. It's an opportunity. Bells and whistles should go off. This is an unusual opportunity where we could make even more money. All right, let's have a look first at the price chart of Harley Davidson prior to and then after this news release came out. The screenshot, you could see all the way on the right side of the chart that huge gap up from 45, which is where HOG was prior to this news release, to almost 55 at the end of the trading day. And that pretty much is in line with what William was stating in his question. So with Harley Davidson at the end of the day trading at 54.25, there was a gap up of $9.25 from the day before. Let's have a look with the assumption now that many of us might have written the near the money 45 call. Let's have a look at a chart of that particular call option. And once again, it's very clear by where the arrow is highlighted that huge gap up in value of the 45 call all the way up to $9.50 where it was at the close on the day of that news release. Now, if you recall from the last chart, HOG was trading at 54.25. So the 45 call was $9.25 in the money. So if we have a $9.50 value on the option to buy it back, that means of that $9.50, $9.25 value, money that we're actually going to get back by increased share value. So the actual cost to close in a scenario like this would be 25 cents. Let me rephrase that so you kind of have an understanding what I'm talking about here. When we sell the 45 call, what we're stating is we understand our shares could be worth no more than $45 as long as we have that contract obligation, because we're agreeing to sell our shares at that price. Once we buy back the option, now our shares are worth whatever the market value is, which in this case is $54.25. So if we spend $9.50 to buy back the option and have a debit on the option side of $9.50, we will then have a share credit of $9.25 because our shares are no longer worth $45, they're now worth $54.25. Net, we have a debit of 25 cents. If we closed the short option and sold the stock, we can now take that cash to put into a different covered call position with a different underlying security, and if we could generate more than 25 cents a share, which should be relatively easy to do as long as there's a few weeks left in the contract, which there is in this particular case, then we will have generated a second income stream in the same month with the same cash. But let's say we didn't act immediately. We didn't act in a timely manner. We decided to hang out a couple days, kind of see what happens. Well, let's have a look at the options chain for Harley Davidson only 2 days later. Okay, here you go, folks. You could see now that on the top left that the price of the stock gapped back down to $47.66. It dropped almost $7 from 2 days prior when the news release came out. Now, if we looked at the options chain for the 45 call in the ask column, what it would cost us to buy it back, you see I've highlighted $355. Now, what is the intrinsic value? Well, with Harley-Davidson trading at $47.66, the 45 call is $266 in the money. So that's the intrinsic value component of that $355 premium, which means the time value or actual cost to close is 89 cents, almost quadruple what it was had we acted 2 days earlier, not to mention the fact that we have 2 days less of time value to generate in our new or second position if we were to use the mid-contract unwind exit strategy. So it should be very, very obvious from this series of graphics that it is so important to take advantage of an opportunity like we have here in a very timely manner. So to get to the crux of your question, William, when a stock gaps up, the first thing that goes into my mind is, do we have an opportunity here for the mid-contract unwind exit strategy where we buy back an option whose time value is approaching zero to then sell the shares and enter a new position, a second position in the same month with the same cash. So it's a wonderful opportunity, but the timing is important as understanding that this is a great strategy to use in this scenario. Now, you can get a lot more detailed information on the MCU strategy in many of my books and DVDs. For those of you who have the complete encyclopedia for covered call writing, the classic version, look to pages 264 to 271. And the complete encyclopedia volume 2, I have a lot of additional information on pages 243 to 252. So it's important that you learn this information and be ready to apply it when those opportunities arise. And it's not rare. They'll pop up almost every month. And that's why, William, your question was such a great one, and I appreciate it very much. And of course, also, thanks to everybody out there for taking the time to watch this video. Hope you enjoyed it, and I hope you make some money from it. As always, this is Alan Ellman, the Blue Collar Investor.
Take care, everybody.